Marc from ADM Investor Services International, with some thoughts on the OECD interim economic forecasts that we had this week, and what we're seeing in financial markets in terms of rate expectations and inflation expectations. So the first table is those OECD forecasts. They are most notable for the fact that the biggest revisions came for the United States, where we saw a colossal upward revision of 3.3 percentage points up to 6.5% for 2021. Also very substantial upward revisions for India, up 4.7 percentage points to 12.6. Indeed, also for Turkey, 3 percentage points to 5.9. By contrast, the UK was reasonably a reasonable upward revision of 0.5 to 5.1. But by comparison, and this is probably the key point, Eurozone still seen lagging at 3.9. That's only a small upward revision relative to November. China was in fact revised down, but one has to say that it remains forecast to expand at a 7.8% percentage rate. My next chart is the US dollar trade weighted index. One of the great consensus trades of the back end of last year of 2020, and indeed in January, was that the US dollar was going to weaken very substantially, that it was going to be burdened by the Biden fiscal package, and that basically everyone would want any currency but the US dollar. Well, sadly, the truth of the matter is, and one can always see this, is that interest rate differentials do matter. And given that the Eurozone isn't going to be picking up as much, those rate differentials between US 10-year yields and Eurozone 10-year yields, whichever ones one might take, have widened considerably in the US dollar's favor. And so we've seen the US dollar strengthen. I think the interesting part from this chart is that it's picked up, it's really only during February that we broke the downtrend that we had since March of last year. My third table is market implied policy rates. I think this is actually a very important one. What one can see on a 2-year time horizon, which is the critical one as far as central bank promises not to move rates are going to be, is that we've seen some fairly substantial moves. We're now discounting a move within the 2-year time frame in the United States. By contrast, one can see in the Eurozone, there's basically no move implied on a 2-year time horizon. And I suppose one shouldn't really be surprised. In the UK, there's a modest move. In some of the other countries around the world, particularly notable Norway, where there's 100 basis points roughly of increases seen, and Czech Republic, 120. And indeed, when one's looking at Australia and Canada, we're also looking at further tightening. Well, quite substantial basis in terms of Canada, 63 basis points, more than the United States. So what is this sort of predicated on? Well, number 4 chart, I think, is an interesting one. It's 10-year break-even inflation rates, i.e. what the market's basically pricing in. And what one can really see is the market is basically pricing in the US inflation to be just above the Fed's target of 2%. On a 10-year time horizon, whereas with the Eurozone, it's basically suggesting that just as with the past 7 or 8 years, the ECB is going to have no more success in the next 10 years in raising inflation rates. This all has, I think is important because it basically tells us that people are expecting US rates to tighten considerably. What worries me in that respect is what's on my 5th chart, which is US dollar investment grade versus high yield credit spreads, and the trend that we've seen of late as yields have risen in the United States. So it's been investment grade spreads which have widened more proportionately than high yield spreads. I think in a tightening interest rate environment, I very much doubt whether high yield credit is going to outperform on that basis, unless one really believes that central banks are going to backstop the market for a long time. But if they're actually going to be forced to move preemptively, then that high yield bet, that high yield spread, looks to be particularly vulnerable to some quite sharp widening. That's the thoughts for this week.